We've got a very special guest joining in this morning, Jahangir Aziz, the head of Emerging Market Asia Economic Research at JPMorgan, joining in. Jahangir, hi, good morning and good evening to you. Does it come as a surprise that ECB has decided to end the quantitative easing come December? And what, according to you, could be the repercussions of this move?
No, I think, this was always something that we had in mind back in January. I think what the market was uncertain about was that with the data in the first quarter turning out to be disappointingly poor in the case of euro area and the political uncertainties related to Italy, in the market there was a sense that the ECB might push back both the tapering and the subsequent increase in interest rates to sometime in 2019 and not do it in 2018. But starting somewhere in September was sort of the consensus view beginning in January. So I think the fact that the ECB has essentially reiterated that position is basically what we get out of the ECB policy from yesterday.
Jahangir, now it's almost confirmed that we are in a rising rate scenario. We are in liquidity withdrawal mode across the world. How does this really play out in terms of what the trend looks like for the markets? Typically, we see the impact first coming into the credit markets and then spilling over into the equity markets. For now, for the near term, it seems like the markets are rejoicing because this is a confirmation of there being strong underlying growth. But at some point that would reverse as the cost of capital goes up.
No, that is true. I mean, I think, no expansion ever dies of old age. All expansions die because the markets the labor markets overheat, prices rise, and then the central bank raises rates to curb inflation. But we're not there yet. I mean, you have reasonably contained inflation even in the U.S., even though it's now in the 9th year, 10th year of expansion. If you look at probabilities of recession, most of them will show that the probability of recession rises up very sharply, let's say from 2020. But one has to keep in mind that these, models of recession, if you want to call them, these are all based on historical business cycles. This cycle clearly has been ahistorical in nature. So our sense is that, look, you're not going to get the profit cycle being pushed back very abruptly. We haven't really seen wage pressures build up that aggressively in the U.S. So there's still time to go for profit cycle to continue, and with that, a reasonable amount of capital spending, and that all of that should be good for global growth. But I think what has been disappointing has been the 1Q disappointment, both in euro area and Japan, and the unevenness in the synchronized global recovery, which we sort of got used to in 2017. So I think we are sort of repricing all of this, and I think the repricing phase may be coming to its end, but it's not over as yet.
Siddharth joining in conversation, and this question is more of an extension of what Tanveer asked you. Currency and emerging market currency is seeing, or some of them are seeing, significant depreciation against dollar. Do you think that currency would pose, or emerging market currency would pose any challenges to global, recovery which is taking place at this point of time?
Absolutely. I mean, suppose we do not see dollar strength actually stabilizing. Let's assume that, what happened today or what happened yesterday in a reaction to ECB's announcement, all of that is a short-term play, and we get back, for whatever reason, back to a world in which dollar strength continues, on a unsustained manner. Then you will see emerging market currencies continue to remain under pressure. And whether you like it or not, these pressures are going to arise or be more intense in current account deficit countries. And at some point in time, they will defend these currencies with FX interventions. But, we all know that at some point in time the game gets over and then they have to raise interest rates. When you raise interest rates, growth in these countries will fall, and as growth falls, you're back to the same, current account deficit economy spiral, that you've seen being played out over and over again. So no, I'm not saying that we are out of the woods. What we do require is dollar strength to stabilize. And in the absence of that, no, I mean, I think the emerging market currencies and with that monetary policy and therefore growth remains at risk.
As it pretty much is the case in every cycle. Jahangir, thanks very much for stitching it all together and giving our viewers perspective on what's happening across the world this morning, and particularly with emerging markets, within which India, of course, is being profiled differently given its macro fundamentals. But even so, if a fall comes in, it will grip all EMs, irrespective of how strong internally those markets look.